With that, of course, looking at the market, at least for now, we are in the positive zone, holding on to that 24,800 mark, although the mid-cap index has slipped into the red and the breadth is looking extremely weak at the current juncture. 1:3, that's the NSE advanced decline ratio. But on that note, let me also bring on board a big market voice. As I had promised at the start of the show, Sunil Subramaniam, eminent market expert, joining in. Sunil, always a pleasure chatting with you. But the mood is pretty grim at the current juncture, right? Extreme volatility, lots of factors at play, confluence of factors, so to say. Earnings expectations were muted, but they have still managed to disappoint. FII outflows record $10 billion, and of course we've seen China emerging as a key threat. They've been, they haven't really announced any substantial stimulus, but they have been doing things to revive their economy as well. Do you still expect Nifty to end the year around that 27,000 mark, or do you think that's a bit overly optimistic at the current juncture?
See, I think a year end is still quite far away because I think the whole move around China, you were right that the stimulus hasn't come out as promised. But the move around China is also linked to the fact that the margin of safety is higher in China compared to India, given the valuation. So if you are allocating money as an FII, the chance of China to fall is far less than for India to fall from the earnings outlook and all of that. So the US elections in November, I think that's the key figure. And I would say by December, the market should show signs of recovery. Whether 27 is going to happen or not, wait and see. But remember that the fall in India could have been much greater if not for the buying by uh, so when FIs come back, we'll see double barrel recovery. So it could be a very fast recovery happening. So just wait for the uncertainty to clear. That's what I.
Right. Let's take stock of the earnings season. The earnings that have trickled in so far. Talking about the FMCG pack, volume degrowth has been a trend so far in the second quarter. The likes of Nestle, Tata Consumer, and they were duly punished by the street as well, as there are signs of urban demand also slowing down. Although rural recovery is expected to be fairly gradual. The kind of PEs, price to earnings that these stocks command. Do you feel that the correction could intensify here on? Your thoughts, and if yes, would it be a pocket that you would look at?
No, you see, I don't expect the FMCG stocks to a big correction because I think that yes, the festival demand is more around consumer discretionary. So I don't think that was factored in. And these are safety plays. So to the extent that they are a big part of the index and fire flows, passive flows, when you say 10 billion outflows, it's not that everybody is pulling out. There's some money coming in and a lot of money going out. So the passive flows would still allocate to FMCG. So I think the downside risk in FMCG is limited. The upside is also limited. So it's a safety play. So I'm not sure that unless we see a strong urban recovery in demand in FMCG, right? Because the commodity prices are the other factor which affect the TPS, right? So we have to watch on both these factors. So I would say stick to FMCG as a safety allocation. No need to make any strong moves either way.
Hmm. Another interesting pocket that I want your thoughts on is the entire cables and wires segment, right? Players like Polycab and Havells, there's intense competition in this space, and given the elevated competitive intensity in the wire segment, companies are making efforts to sustain the strong growth trajectory as well. How do you see the growth potential here, and valuations wise, do you feel they are expensive and one should wait for some kind of dip to get into these stocks?
I think the potential for them is good, given the kind of you're seeing. You saw the real estate sales in Mumbai over Navaratri. Cables and those are naturally linked to the construction sector. But I agree that valuations too are stretched. So I would say at this stage, wait and watch. I'm not really concerned, but I don't think they've corrected. You have to wait for some more correction if you want to add now. The valuations are still a bit.
All right, a couple of more questions then. Moving to this hot debate or raging debate over how festive demand is really shaping up, at least in the auto space. We had Mr. Rajiv Bajaj speaking to CNBC TV 18 yesterday and said that the markets are reacting based on a temporary understanding to an evolving situation. Would you also be in the camp that believes that festive sales will pick up as we go ahead? And he's undeterred and he's stuck to his target of 20,000 rupees on his stock. But obviously, we'll not be talking about stocks and targets from you. But do you see the festive sales picking up pace as we go ahead into the festive season? And uh, after the dream run in autos, is it still time to stay put, or is it time to take some money off the table and rotate into some underperforming sectors that have better potential?
Okay, that's a lot that you put on the table. See, I the festival season demand. I mean, it's a bit early to say because Diwali bonuses get paid around, closer to Diwali, and Christmas also follows. So I still retain a little bit of optimism that festive sales will pick up. Now, obviously, the market was over anticipating, and there has been a correction reaction because initial festive season numbers haven't played out. So Rajiv Bajaj has this perspective, but I would say that generally speaking, that uh, this festive season, there is, I think, an impact of inflation on people's pockets, right? I think food inflation has hurt quite a bit. Petrol prices and all haven't come down. So, to that extent, I think that, and I will also make an interesting point. I think people are more savings oriented now. I think if the data comes out, you'll see that from the consumer surplus, people are relating little more to savings than to consumption. So there has been a sentiment issue around consumption, I think, for quite some time and still taking time to pick up. The data on the ground is not yet supportive of any strong festive season, but I still retain hope. If you wait for another week, we'll get a better sense of it. Now, from a valuation perspective on auto, see, the point is that two wheelers, for example, if you look at, right, they're strongly reliant on rural demand to pick up. Now, while rural demand has been growing faster than urban, you haven't seen the kind of strong pickup in the two-wheeler segments that was anticipated despite a good monsoon, right? So that then tells me that it's a time to be a bit cautious on the two-wheeler side, but longer run it should pick up, and I think the whole K-shaped recovery bit is still playing. It's still the high-end products on the real estate auto that are selling more than the low-end products. So I think we have to reassess the situation post the festive season to see what call to take on the auto pack. I think let's wait for the festive season numbers to actually pan out. And I'm quite keen, like Mr. Rajiv Vijay said, I'm quite keen on the commentary of the companies, right? Rather than the actual numbers of the season, I want to see how they look for the year ahead. That would be a more critical decision making on whether to buy some of these sectors and stocks, because I think the market is also in a right position to start discounting FY26. So this, while this initial disappointment might be there, if you look at the guidelines for next year and then take a call, would be a better bet, and I think the market will also react that way to that.
Right. I will have to let you go on that note. But before I let you go, what would your top, picks be for the new Samvat? Obviously, no recommendations, but what's on your radar?
The top private sector and top public sector bank, both of these I think will do very well.
All right, that's the view then. Private and public sector banks poised to do well in the new Samvat. With that, Mr. Subramaniam, always a pleasure chatting with you. Look forward to connecting with you again. Have a great day.